GC sulking in trade. Rahul Veera, Fund Manager, Equity Investments at Nippon India, AIF, is now with us on the show. Rahul, thank you very much for joining in. So how are you going about navigating this market? April, we saw markets snap back, though towards the end, we've started consolidating a tad bit. You all had a cash position of about 14%. Have you started deploying it? And if yes, where?
Yeah, hi, good afternoon to everyone. Yes, so we have started deploying the cash. We remain positive on the markets going forward. So almost last 1 week, we saw $570 million of FII flows coming in. So very clearly the indicators from the macro front, right, all the peak pessimism that was playing out gave us a good opportunity to deploy in the past 1 to 2 weeks for sure.
Now, what is the cash on the books?
Will be less than single digit.
Single digit now?
Yes.
Versus about 14% towards the end of...
We deployed almost 7% itself in the past 1 or 2 weeks.
Oh, okay.
Yeah.
And do you want to tell us where you deployed? What are the, we can see that you like M&M, HDFC Bank, Reliance Industries. These are all stocks that you are overweight on. But broadly tell us, incremental money, that 7%, where is it gone?
Yeah, so the names that you took, but incremental we'll be looking forward to add some mid-cap and small-cap names in the multiple sectors as well.
All right,
so
Rahul, hi.
The sector that we like, yeah.
Okay, which is the sector you like? Sorry, missed that.
Cement is the sector that we like. We are incrementally positive on the cement sector.
Indeed. Okay, Rahul, good to speak to you, and thanks a lot for joining in yet again. Let me quiz you on both those 2 points. Last number that we have is your cash was at around 14%, which you're telling us has come down now to single digits, and your large caps accounted for around 59%. Now, given that the incremental money you'll start deploying in mid as well as small caps, what is the mix you're looking at between large caps, mid and small caps? If you could help us out with that. And the second point on cement, since you like cement, what are you going for? The big boys who are ruling the roost, or the smaller names that will have to come to the table and probably sell out?
So we are trying for a mix of both. We are going with the large cap names, so higher allocation will go towards the large cap name, and some of the mid cap, small cap names where there is a potential acquisition target remains there.
Okay, all right. So that's about cement, mix of names. You want to give us a hint? Between the large cap names we know, but in these potential targets, which segment are you looking at? I mean, is it the south-based guys? Is it some guys in the north-based?
So one of the south-based guys are having a very large debt. They're going for probably group-level restructuring. There could be some decent alpha generation. Also, if you see for the past 2 months, the maximum price rise in the cement prices has happened in the south region. We believe this will help in your deleveraging exercise as well. Plus, the debt to EBITDA ratio that we are expecting over the next 2 to 3 years will come down very significantly. Will help one of these South region players for sure.
And overall, in terms of your, allocation, what are you looking at? Large, mid, and small cap?
So broadly, from 59% of large cap will come down to 53 to 54. So incremental allocation is going to go towards mid cap and small cap.
In the last 1 month, you're also brought down your holding in IT names. I think TCS, Infosys were stocks where you've lowered your holding or weightage. We know the reasons, but how are you thinking about IT now at this juncture?
See, they remain a value buy, but at 4 to 6% growth for the large cap names, right? Giving a 20-25 times multiple. They largely are like dividend yield stocks going forward now, 4 to 5% of yields that are coming through in these names. But incrementally being an alternate asset investment manager, we look for alpha names, pure bottom-up stories. These are more of allocation names going forward. So we believe that they will not be very high alpha generation in these names as of now.
Okay, got that sense. Rahul, hi, good to have you on the show. On financials, because it's a very, very wide and diverse basket, and stock reactions are also so different, right? Wherever there are growth concerns today, Kotak or SBI, stocks are falling. Wherever NBFCs were showing any sort of issues with margins, again, there was pressure. What are you liking and what are you avoiding here?
Yeah, so see, from a broader allocation perspective, we prefer NBFCs over banks, right? As I discussed last time, that the credit growth in the system, although the overall sell side is managing close to 14 to 15% of credit growth, we are working with 11 to 12% on the broader PSU as well as the private bank baskets. So when you see those numbers, the kind of valuation we are seeing is slightly on the higher zone going forward. So we prefer the NBFCs over banks. And within NBFCs, again, home financiers is where the compounding will happen, and some of the MFI names where some of the alpha generation will happen from a bottom fishing perspective.
Okay, Rahul, how are you approaching Pharma? I can see Mankind Pharma as part of the pack. I don't think it has much global exposure as of now. It will be reasonably protected from Trump's tariffs. So that's the way you're going?
Yeah, so that is one way to look at it. CDMO plus domestic pharma is the overall allocation that we are looking forward to. From the larger branded generics on the global side, we are avoiding the bigger names as of now.
Since Mahindra & Mahindra is an overweight for you, you would be tracking it very closely. For fresh investments at this juncture, at this point after the kind of outperformance and the expectations that is set in, will it be able to beat and generate alpha?
Yes, we are positive on the name. Going forward, see, it has a little bit of rural exposure as well via the tractor exercise, right? Almost 40% of the EBITDA comes from the other rural exposure that they have. We believe the kind of EV plus UV plus the tractor exposure, I think it's a very good combination to have in the portfolio.
So even at these levels, risk reward is fairly favorable.
Yes, absolutely.
All right, Rahul, what about Swiggy and Zomato? I'm guessing you will be using the apps. But what about allocating money? Do you like any of them? As we speak, Swiggy is actually up close to around 10%. They had put out a filing regarding Bolt, which is their quick food delivery platform. They are saying that is doing very, very well on a day that Zomato went ahead and said that they are looking at shutting that down. So it seems the street is, grabbed onto that piece of news. We need to see how the quick commerce delivery itself does pan out. But at least in this vertical, the quick food delivery platform, they are talking it up. Any exposure to these platform companies? Do you believe that Swiggy should be catching up with Zomato, or do you think it's going to get far too competitive? You'll stay away.
Yeah, in the seed, over the next 6 to 12 months, we'll see the outcomes, right? Where Zapto in the quick commerce is playing out their best. The recent update that we got from the management of Zapto that they had to raise funds at the personal individual level, right? At a 16% credit that they're seeing. So we see that competitive intensity may like for 1 or 2 quarters more, but going forward in the industry, we believe it's going to be medium-term positive. So from allocation perspective, we are looking at these names, but at least for 6 to 12 months, we'll have to take we'll be in the watch list, and probably then we may relook at the names again at that point of time.
eClerx? I mean, eClerx is a stock that you track, right? And I think you own it in one of the portfolios. Now it's underperformed, 28% down so far on a year-to-date basis. If I look at it from its 52-week high, the stock is down 35%. What makes you bullish? Is it the fact that its stock is corrected and therefore it's now attractive? And it's also an industry which generative AI can disrupt.
Right. So see, if the diversification that the management is focusing, right, away from the proper BPO services to moving towards KPO services, they are diversifying from that. So even they are well aware of the AI disruption can get, but the management, we are very confident that they will be able to diversify going forward. Now, in terms of valuations also, some of these names in this pack, in the KPO, BPO pack, are relatively better off than the IT pack that we saw in the large cap names. So we're seeing some growth here, and the multiples are also relatively better in some of these names.
Okay, all right. Final question before we let you go, Rahul. Wanted to ask you on this renewable energy theme. Solar, people were talking it out. Suddenly you had Vari Energies that came out with a brilliant set of numbers. The stock saw a sharp spike up, then everyone said the lock-in is ending. So now the stock will come under pressure. As we speak, the stock is up close to around 5.5–6%. They have guided for very good numbers in the remainder of this fiscal. So it seems for the time being, the sun really hasn't set on the sector.
Right. So see, for solar energy, right, almost the guidance from the government is close to 50 gigawatt per year for the renewables, but the execution has been close to 22 to 24 gigawatts per year basis. So incrementally going forward, we believe the growth will be there in the industry, but what are the valuations that we're paying for, right? So we have been on the sidelines for this sector. We believe post FY27, FY28, without any government incremental regulations which are supporting the industry, we believe the ROEs may not sustain. So we have a little bit of concerns around this sector. We've been on the sidelines for the names.
Thank you very much for joining us, Rahul. Great chatting with you. Need to get into a